Welcome to InsightfulValue.com Knowledge Base. We all know financial markets can seem like this wild, chaotic swirl of flashing numbers, algorithmic noise, and a 24/7 news cycle that just never quits. But today, we're taking a step back. We're going to look at the objective framework that cuts right through all that noise. We're breaking down the core principles of market analytics and exploring exactly how they power that legendary, battle-tested strategy we all know as value investing. It's this incredible combination of rigorous data and serious psychological discipline, and this explainer is going to map the whole thing out for you. Let's get right to it.
Now, real quick before we unpack these concepts, I need to make it absolutely clear that this explainer is strictly for educational and informational purposes. I'm here to share historical frameworks and analytical philosophies with you, but this is definitely not financial advice. Your financial situation is entirely unique to you, so please use this info to level up your own learning, not as a green light to go out and buy or sell any assets. Make sense? Awesome.
Okay, let's dive into this. Our roadmap today covers 4 quick stops. We'll start by decoding market analytics, then move on to the value investing philosophy. After that, we'll look at evaluating true business worth. And finally, we'll wrap up with the analytical investor mindset. Think of it as our detective's journey to uncover true business worth.
All right, Section 1, decoding market analytics. Think of the modern financial market like a massive, incredibly noisy bazaar. People are shouting, emotions are running hot, and prices are just wildly swinging based on the latest rumor or macroeconomic panic. Well, market analytics is basically our detective's magnifying glass in this crazy environment. It's the systematic process of gathering and interpreting actual financial data to evaluate businesses. We're talking about filtering out market sentiment and focusing on raw, unyielding data, things like cash flows, debt loads, and capital allocation. It's all about relying on hard math and historical context to strip away the hype. That way, you can see the actual structural health and cash generation capacity of the company you're looking at. Moving right along to Section 2, the value investing philosophy. So if analytics is our magnifying glass, then value investing is the core philosophy guiding our entire investigation. It's an investment paradigm focused purely on finding and acquiring businesses that are trading for less than their intrinsic value. To really grasp this, think about everyday shopping. Your goal is to find a super high-quality item on sale for a fraction of what it's actually worth, right? Same thing here. Think of Benjamin Graham, Warren Buffett's early mentor, who famously talked about buying a dollar bill for 50 cents. It is definitely not about hoping a stock becomes a meme or chasing the latest speculative tech trend. It's a rigorous hunt for fundamentally sound businesses that the broader market has temporarily mispriced, maybe because of institutional constraints, a short-term earnings miss, or just general economic pessimism. And this brilliantly illustrates the most critical distinction of this entire philosophy. On one side, you've got price, which is just what the market charges, and on the other side, you have intrinsic value, what the business is actually worth. You see, short-term pricing is heavily driven by liquidity needs and behavioral economics. Basically, it's a popularity contest fueled by fear and greed. But intrinsic value? That's anchored in real, discounted future cash flows. A seasoned analytical investor completely separates these two concepts. Your whole job is to exploit those moments when that popularity contest drives the price tag significantly lower than the mathematically derived intrinsic value.
Now for Section 3, evaluating true business worth.
We've talked about the theory and the philosophy. Let's move to and see how this builds a methodical, step-by-step process for uncovering a company's hidden value. Getting practical here, step 1 is to relentlessly gather financial data. You're pulling annual reports, you're scrutinizing balance sheets, and you're tracing the cash. Step 2 is applying market analytics. This is where you filter that raw data through your framework, comparing historical performance and capital returns against competitors. And finally, step 3 is determining intrinsic value. This is the exact moment you calculate a highly conservative estimate of what the business is truly worth, completely ignoring whatever the daily ticker tape is screaming at you. Now, what's really interesting about this slide is the significant, glaring gap you see between the lower market price and the higher intrinsic value. That gap is the absolute holy grail of risk management in value investing. We call it the margin of safety. Look, investing is never a perfect science, right? Our models can be flawed and unpredictable macro events happen all the time. But if your analytics value a business at $100 a share and the market is offering it to you for $60, that $40 gap is your protective buffer. It absorbs those analytical errors and economic bumps. It structurally minimizes your downside risk while keeping your upside fully intact.
Finally, we've arrived at Section 4, the analytical investor mindset. Here's the thing. Mastering the math is literally only half the battle. The other half?
cultivating the psychological discipline required to actually execute the strategy. Ultimately, the analytical investor acts like a profoundly rational detective. First off, they rely strictly on hard data, completely tuning out market emotion and the endless noise from financial media. Second, they hunt for fundamental, long-term business value. They honestly don't care where the stock is going next Tuesday. They care about the free cash flow 5 years from now. And third, they patiently use market analytics to uncover pricing discrepancies. They strike with absolute conviction only when the market practically hands them a fundamentally mispriced opportunity. So the crucial point is this. Are you buying a business or just buying a stock? Think about that for a second. It's not just semantics, it's a monumental shift in how you view capital allocation. When you just buy a stock, you're basically speculating on liquidity and momentum. But when you apply market analytics through the lens of value investing, you transform into a true capital allocator. You are acquiring a living, breathing enterprise based on its actual, tangible economic output. As you continue your own journey into financial literacy, keep that distinction front and center. Are you a speculator or an owner? Thanks so much for joining me for this explainer.